Welcome to Pominkiewicz Markets Uncut podcast, your weekly insight into the topics and issues that we discuss here at Pominkiewicz. My name is Oli Creasey. I'm normally the property research analyst here in the London office, but today I'm your host, and I'm here with regular commentator Richard Carter, who you all know very well by now, I'm sure, and also our guest commentator Jarek Pominkiewicz.
It's Pominkiewicz.
There you go. I apologise to Jarek and also any other Polish listeners that we have, because that is outside of my skill set, I'm afraid. But Jarek is our capital goods analyst here at Pominkiewicz. I'm sure he's got some interesting insights to add as well. But we'll come to Richard first, as usual. Another busy week in global politics, Richard, and last week and this week looking like more of the same. I can't imagine that you could summarise the goings on in Europe in short order, but it's your job to try anyway. So perhaps you could just remind the listener of what's going on in Europe at the moment.
Yeah, it is hard to summarise, but I'll do my best. I mean, I think obviously events have been, since Trump's gone into the White House, been ridiculously fast moving, not just on tariffs, but now on Ukraine. And in fact, the whole sort of European security framework that's been in place for decades now. I mean, clearly the big focus is on the war in Ukraine and how to end it. But the American approach at the moment seems to be to do a deal with the Russians potentially over the heads of the Europeans and Ukrainians. How far that goes, we'll have to wait and see. But clearly, Europeans are very concerned now about how committed the Americans, or certainly the new administration, is to NATO and providing security for Europe against an expansionist Russia. And all this was brought a little bit to a head at the Munich Security Conference last week, not helped by a bizarre, a very interesting speech from the Vice President J.D. Vance that seemed to potentially could have been written in the Kremlin itself and attacking European democratic values, all ahead of a German election taking place in a week's time. So it's a big deal. We won't know the repercussions, the actual outcome for some time, but clearly there's going to be negotiations between the Russians and Americans on how to resolve the Ukraine war. Whether the Russians are serious about peace remains to be seen. But also you've got the angle that the Europeans really do need to step up now and spend more on defence, not just spend more money, but also have better coordination, because potentially the Americans might be less willing to come to their rescue in future. So there's lots of talks going on about that. It's against the backdrop of tight budgets and wide deficits in Europe and the UK. So governments don't really have a huge amount of spare cash to spend on the military, but they're going to have to go and find a way now to do just that. So it's got potentially big ramifications for Europe, and we'll be keeping a close eye on developments.
Thanks, Richard. I'm glad you mentioned the German election, because I'm aware that I think Macron's kind of put up the NATO bat signal and asked European leaders to sort of come together and talk this out. How challenging is it to do that in the backdrop of an election happening in, well, as we record now, 7 days' time or so? Who do you invite from Germany under those circumstances?
Yeah, it's a good point. I mean, it certainly is the NATO or the NATO ex-US bat signal. Although, as everybody thinks, there's some people excluded, and they get very upset about it. One, obviously, you don't exclude Germany, because whatever happens in terms of military arrangements, they are going to be absolutely crucial, along with the French, the Poles, the British as well. There's a number of different countries that are going to be very, very critical to this. I think as far as the German election is concerned, and German politics in general, well, there's a lot of talk about the AfD and some of the other parties, but stability reigns in some ways. The chances are you're going to go from an SPD led government-led coalition with Olaf Scholz in charge, who will be obviously attending the summit, and you'll go to a new coalition led by Friedrich Merz in charge of the CDU. So it's the centre ground, one centre ground party replacing another. They're both of a similar mindset, really, when it comes to defence challenges and spending challenges. So I don't think, whatever the outcome of the German election is, unless it's a huge shock, there should be too much trouble for Germany coming to a decision along with French and other powers on what to do.
Well, that sounds like a little bit of a relief, at least. And I guess in the meantime, of course, we've got UK CPI numbers this week as well. I don't know how much time you're spending thinking about those these days. But any thoughts? Should we be paying as close attention to that as we normally do, or is it?
Yeah, I mean, I think it is difficult at the moment. I mean, sometimes markets are quiet. You sort of worry about inflation numbers and these sorts of things. At the moment, there's sort of bigger fish to fry, along with with the tariffs and the whole defence architecture in Europe. They do. I mean, central banks are still critical for markets. Let's not forget that. And central banks are driven by what's going on, growth and inflation. At the moment, the Fed is absolutely on hold, on a sort of wait and see mode, because US growth is holding up. In the UK, it's a different situation. The economy is kind of stagnating, but there is this danger that inflation heads up in the near term because of various cost rises and tax rises we've got taking place at the moment. So the inflation numbers do matter. The chances are, the Bank of England will be cutting rates again before long. But clearly, if we get a big spike up in inflation in the next few months, that will mean they have to proceed with a bit of caution.
Brilliant. Thank you, Richard. So I'm going to bring Jarek into the conversation now. Capital goods analyst. We're well into the sort of year-end results season here, Jarek. Could you maybe just sort of summarize your markets and your sector as best as you can?
Yes. So if we look at the economic indicators for the capital goods space, I think the best one to look at are the manufacturing PMIs, so Purchasing Manager Index. And here, essentially, the manufacturing sector across the world has been a little bit subdued. I think the best conditions so far we've seen is in the US, where the index in January moved above 30%, which denotes expansion for the first time. Production volumes rising for the first time in 6 months. And optimism generally post the election of Trump is pretty positive. And there is kind of consensus among firms that conditions will improve under the new administration. Elsewhere, it's a little bit less positive. The downturn in UK manufacturing continues. The metrics have improved in the UK a little bit versus the 11-month low in December, but at 48 reading for January, it's still below 15. Companies are facing essentially pretty weak market demand, rising costs such as minimum wage and employer national insurance increases, as well as somewhat deteriorating outlook. Europe, you can always only really broadly kind of describe it as being less bad than it was in the prior few months. Manufacturing PMIs are around 46, 47 mark. It's an 8-month high, but on the one hand, confidence is starting to pick up a little bit more than before. It's, the European manufacturing is really in the midst of recession and downturn. So in the kind of headline, it's not terribly positive, although some early green shoots are starting to emerge.
Great. Well, just in time for those green shoots, of course. We're doing tariffs now, so is that going to
tariffs and Trump?
Kill those shoots off at the root, or
yeah, it's difficult to call, because we can start a week with announcement of impending tariffs on Mexico and Canada, and by the end of the week, they're pushed out onto the horizon. So essentially, there's quite a lot of uncertainty that's creeping into decision making, investment making, and this, it doesn't bode well, right? Because if you don't know what sort of scheme you're operating in, it's only likely to delay investment programs by months, if not more. I think by and large, if you look at Trump's policies, he's always been expressing a view that he wants to use tariffs essentially as a tool to address what is, in his view, as an unjust trading balances between US and other countries, with a view of bringing in manufacturing back into the US. And, by and large, that is a positive for US industrials. And I think the automation names in particular, because the cost of labor in the US is by and large larger than outside. And in order to hence to keep the cost down, I believe that if we do see much of a reshoring back into the US, it'll have to incorporate a lot of more automation solutions. In terms of tariffs and bringing back some of the manufacturing of components from Mexico into the US, look, the tariffs definitely would push prices up. The signaling from US manufacturers and some of the European peers that sell into the US is that they have essentially developed contingency plans to implement rapid price increases to address the increased cost for them in order to minimize the impact on margins. So I think we'll see very quickly the increase in cost to American consumers, and then over time possibly a shift into the US. But these are kind of the more kind of longer term impacts. But yes, I mean reshoring, I think it's a very strong theme, and this whole thesis behind this looks at WTO and the joining of China, and before that, for decades, the capex spending or the spending on manufacturing capacity in the US grew at about 4 percentage points per annum and dipped to under 1 percentage point since. So the view is, or the kind of understanding is that US policy right now is to bring some of that manufacturing and reverse the loss of share that the US has seen in global manufacturing from about 16% of global manufacturing that it has right now to somewhere towards 25 that it had before China joined WTO. How realistic that is, it's difficult to tell, but definitely it's somewhat of a tailwind for the automation names in the US and Rockwell, which is the kind of the one of the primary automation companies in the US will be the one that is best placed to capitalize on this theme. And it's particularly positive as well that we've seen in its recent results. We've seen an inflection point in its demand for US factory automation space. The orders are finally growing, and the factory automation cycle, which has been pretty subdued for the last 2 years, is turning. So I think there's scope for multiple expansion there as market gains confidence in the improved demand outlook and company execution. Maybe kind of continuing the automation theme in Europe, we had recently last week the Siemens Q1, their fiscal Q1 results, where their digital automation business, which also has suffered from severe destocking over the last two years, looks like it's turning a corner. Its orders have returned to growth, driven by both software, but more importantly, automation hardware, and exceeding revenues for the first time in 2 years, which is a positive turn, or very much a positive on Siemens, which I think it has probably the best strategic positioning in industrial automation, hardware and software versus its peers, and these versus peers that are trading at much higher multiples. So with the stocking in China, gradually coming to an end, we should see a cyclical recovery in digital industries automation business, and that should help to drive margin expansion in the coming years. And moreover, Siemens management are reviewing a stake in Siemens Healthineers, which would, I think, any reduction here below 50% would help to address the conglomerate complexity within Siemens and help its shares re-rating as closing the relative discount, conglomerate discount versus peers.
Brilliant, thanks, Jarek. Now, I'm aware that you used to be, as well as a capital goods analyst, you also used to be the aerospace and defense analyst. And given the current climate, it would seem remiss of me to not seek your opinion. I realize you perhaps don't want to step on any toes elsewhere in our analyst team, but perhaps you have opinions as an individual rather than an analyst, or something that you might wish to share with us.
Yes. I mean, if you look at the reaction to the Munich conference, we hear a lot about a wake-up call for Europe, and it just feels it's another one of those, because we seem to have had a few of these, and it seems like in Western European capitals, the view is that war, even if it's on Ukraine, on the European continent, it's really happening to somebody else. It's happening elsewhere. And we talk about the need to increase spending on defense, and of course, when you have other pressing issues like education and healthcare, it may be difficult for these governments to feel like it's difficult to find funding for defense. But in reality, I think for some countries it's being perceived as an existential threat. Poland, for instance, managed to increase the spending from just over 2% of GDP before 2022 to over 4%, and it's definitely spending quite a lot on purchasing equipment to rebuild the stocks of arms that's donated to Ukraine. And I think with the messaging that we're hearing from the US of Europe essentially needing to take responsibility for its own defense, I think we should see a lot more from Europe as well, beyond the 2 percentage points. Some countries, large economies, Europe, are not even spending that amount. Look at Italy or Spain, but the 2.5 is definitely not adequate. I think we should see spending going beyond 3.5% as an order of magnitude, and quite possibly for more sustainable period of time, not just a year or two, but for decades, possibly. And it's down to the question really stands of how much support Europe will offer to Ukraine, whether Ukraine will be forced to accept peace on Russia's terms, and what that will do to Russians' appetite for further adventurism beyond Ukraine, possibly looking into Baltic states and Poland. I'm cognizant of the fact that these are NATO countries, but in the aftermath of the messaging from the US, one may doubt whether how much of a commitment there is to stand behind the Article 5 of NATO, and whether these countries, whether the US would come to the rescue of Eastern Europe. And really, the only way to deter Russia is to build up your armies and show that you're not afraid of a confrontation should it come.
Well, thank you. Yeah, I mean that's a bleak
It
start.
is a pretty bleak assessment. It's a bleak assessment, but we cannot keep denying that this is the world that we live in. And in the near term, it's definitely positive for the defense stocks such as BAE, which is the premier US defense company, UK defense company that we like. But yes, this is the world that we live in. It's definitely full of threats, and what would have been unthinkable just a few, if not years, then even months ago, I think it's slowly becoming a reality, and this is the world that we're facing under the Trump administration.
Thank you, Jarek. Honest and insightful, and much appreciated. And I will say the same of Richard's comments as always as well. So I think we're probably out of time, to be honest. But thank you both for coming in and spending your time giving us and the listener all of those insights. So we will draw to a close now, but before we do, I'll just give you the regular spiel, but please don't press skip right away. First of all, to say thank you for listening, but also if you have any questions for myself, for Jarek, for Richard, or anyone else here at Core to Tribute, please do get in touch. We do read them and we do respond to them as well. So send them via our weekly comments page on the website. And of course, do make sure that you are staying up to date with our thoughts on markets and other issues. The website's called achieveit.com. It is out there and you can see more of what we're doing, as well as watching some of the past webinars that we have. And of course, subscribe to the weekly comment newsletter if you haven't already. We will be back at it again next week. But in the meantime, of course, do click on the socials, get up there on Facebook, Instagram, Twitter, LinkedIn, everywhere else, and see what we're getting up to in the meantime. So thank you for listening. And thanks again to Richard and Jarek for joining us today. Bye for now.
Thank you.